Hello and welcome to Charting Essentials with me, Shaun Murison, Senior Market Analyst at IG. Today I want to talk about oscillators. Now, very commonly used when we talk about oscillators, we talk about things like stochastic, RSI, Williams percentage R, momentum, the list goes on. But I think a lot of those indicators are misused, and hopefully we can correct that behavior and give you some tips and tricks to help improve the probability of these indicators actually working in the market. So firstly, the most common technical oscillators used are the stochastic and the RSI. So I'm going to focus on those two in particular, or even one, but the interpretations, like I said, are the same. So it's not really, the way you'd read the other oscillators is the same way you read these. Mathematical formulas are slightly different, but interpretations are the same. Oscillators give us overbought and oversold conditions. Oversold is a suggestion that the market has fallen, could be setting up to have a brief rally. Overbought suggests that market rally has maybe gone a little bit too far. Maybe we could see a short-term decline. Oscillators, the ones that move between 0 and 100 are range-bound in nature, banded oscillators. They give us overbought and oversold conditions. Move out of oversold could be a buy signal. Move out of overbought could be a sell signal. Is it really as simple as that? Can you really just trade like that? How often does it work? 50% of the time, it works every time. I think it needs to be applied to the right market environment. Range-bound indicator, best applied to a range-bound environment if you're looking at signals with long and short signals and looking at following those. I think you can improve that probability by combining with other technicals, an oversold signal at a support level, an overbought signal at a resistance level. When the market's in an uptrend, we look at signals to help join that uptrend. So we look at oversold signals. So if you get an oversold signal, but that market's in a general uptrend, essentially you're buying the proverbial dip, right? So you're trading with signals that are in line with that trend, because these are momentum indicators. So you've got a momentum signal in line with a longer term uptrend. So that's one way of using it. Now, the overbought signal, what's happening with that? So the market's run into this overbought territory, but it's still in an uptrend. We don't trade against the trend. If you're long, maybe you're going to use that as a signal to exit your long trade. All right, but for me, it's not a signal to go short in the market, trade against that general trend. And then you could look at a downtrend. If you assess that market to be in a downtrend, you'd be looking at signals to go short. So maybe overbought signals as a trigger for a short entry, and then oversold signals now as signals to maybe exit that trade. Quick recap. Oscillators give us overbought and oversold conditions. Oversold is a suggestion that the market has fallen, could be setting up to have a brief rally. Overbought suggests that market rally has maybe gone a little bit too far. Maybe we could see a short-term decline. These are range-bound indicators. Suggestion is they work best in a range-bound price environment. If you are using these indicators with a trend, the market is in a trend, then we like to look for signals with that trend as possible entry opportunities, and signals against that trend as possible exit opportunities, not as signals to trade against a prevailing trend. Personally, I'm not looking at having 10 different oscillators on the chart and trying to line them all up to see, when they all line up, that's when I should buy or that's when I should sell. I think that habit is duplication of information, and that's my personal opinion. And I think what people often tend to do, and I think in my early days I probably did the same, is find they don't always line up at the same time, so you start looking for the signal that fits in with what you're thinking. So if you're looking for those indicators or those oscillators, you can find them around over there. All right, traders, remember your job is not to trade frequently, but that job is to trade well. So good luck out there. I'll catch you in the next episode. Shaun Murison, Senior Market Analyst at IG.